This is video 6 of example 11 dealing with the category financial liabilities at amortized cost. We have already looked at the journal entries on initial recognition on 1 January 2011. We are now going down the timeline and we get to the end of the first reporting period, 31 December. We now need to account for the interest that has accrued over the period of the first year, over 2011. So the interest that goes to profit or loss as finance cost is the balance on the debenture liability times the effective interest rate. We are using the effective interest rate method. We are calculating the effective interest that accrued in 2011. Our journal entry is to take it to finance cost because we are the issuer. We have to pay the interest to the investor, debit our finance cost, and the credit goes to the liability. Please think back to IFRS 16 leases where you also accounted for the interest on a lease. You first add the interest onto the item and then your second journal is the payment journal. So the first journal is account for the interest that has accrued. With a financial liability, you calculate it by taking the balance on the T account of the liability times the effective interest rate that you had to go and calculate because this question has transaction costs. How did we calculate that balance? Just to make sure we all know, it is the initial recognition at fair value of 990 reduced by the effect of transaction cost because we paid our broker. The second journal that we have to recognize is the payment. So first bring in the interest, then take out the payment. So what is the payment that happened on this date on 31 December 2012? Credit bank with the interest. The issuer pays the interest in cash. The cash flow amount is nominal value times nominal rate. That is the amount that we pay for the liability so far. So you reduce what you owe. You reduce the liability. Credit bank, debit debenture, liability with the cash flow interest. Nominal value times nominal rate. We can now go and calculate a new balance on the debenture liability account. So you can draw a T account if you want to, or you can just take all the different journal entries into account and you look at a new balance on the debenture liability account. It's the day one balance, add on the interest, deduct the payment, and we get a new balance. This balance is amortized cost. If we say we account for a debenture, a financial liability at amortized cost, that is what the balance is. It's called the amortized cost. The fact that you do amort, that you bring in interest and deduct the payment, this balance is the amortized cost. The fact that you did these journal entries the way you did means you are accounting for this liability at amortized cost. We now go down the timeline and we get to the end of year 2, to the end of 2012, 31 December 2012. What are the journal entries we need to look at? Well, first of all, we need to account for the interest. So we will say finance cost through profit or loss. It has to be at the effective interest. We are using the effective interest rate method in the category at amortized cost. How do we calculate that? We use the balance on the T account that we just calculated at the end of year 1 times the effective interest rate that we had to go and calculate because there were transaction costs. So we take the debit to finance cost. It is a finance cost, an interest expense for the issuer. They have to pay the interest to the investor. The credit entry goes to the financial liability, the debenture liability. Please think back to IFRS 16, how you accounted for interest there. The second journal is the payment journal. Credit bank, we actually pay the interest. The cash flow payment is always nominal value times nominal rate. That is what was agreed in the debenture contract. That was the returns that the investor knew they would get in cash. Credit bank, nominal value times nominal rate, and reduce the liability because you have made a payment. You have paid the interest that accrued. Now you can again, at the end of the year, go and calculate the new balance on the debenture liability. It's the balance at the beginning of the year with all the transactions that happened now. You accrued interest and you did a payment. That new balance is again the amortized cost at the end of 2012. This is amortized cost. The fact that you did the journals the way you did them means you are accounting for the debenture at amortized cost. You bring in the interest, you take out the payment. But on this date, 31 December 2012, there was not only an interest payment, there was also a maturity payment. So credit bank, 550, we have calculated that amount. Debit the liability because you have repaid part of that liability. And then you can recognize the new balance at the end of 2012 after the payment has been done. That balance, that final balance after all the journals are done for this year will be the amortized cost, which will be on your statement of financial position. Just a comment on this point. Remember in your statement of financial position, any asset or liability, you have to decide, is it a current asset, a current liability, a non-current asset, a non-current liability. So the same applies to financial instruments. You need to decide this debenture liability, will it be under current or non-current liabilities? How do you decide that? You look at the balance at the end of each year and you ask yourself, is anything in that balance that will be repaid within the next 12 months? It is already included in the balance. You have added it onto the balance. You've changed the balance. It's in there. And it will be repaid within the next 12 months. That part of the balance that will be repaid within the next 12 months, that will be a current liability. The rest will be non-current. Now, if we are at the end of 2012, our balance is 508 Rand and 5 cents. Is this current or non-current? Well, the entire balance, everything that's in there, will be repaid within the next 12 months because we know this debenture matures in full. Final maturity happens at the end of 2013. So in this case, it will be a current liability. But you could find that sometimes a portion will need to be under current liabilities while the rest might be non-current. So you ask yourself, what is already in that balance that will be repaid within 12 months? That portion is current, the rest is non-current.